You're paying more for the same roof, and the exits are back. Insurers are pulling out of risky markets, premiums are spiking, and regulators are changing the rules mid-game. Louisiana loosened cancellation caps and sped up rate approvals to bring back competition. The result? More homeowners funneled into Citizens at higher prices. Watch as we break down the dominoes. Reinsurance costs surge, labor and materials rise, and new rating models in places like California tie your premium to predicted catastrophes and mitigation. Then, I'll show you the counterintuitive fix. Plan for uninsurability, not just unaffordability. Before we move on, please take a moment to subscribe to the channel and like the video. You think calling 5 brokers will fix it? It won't. The floor moved. The average premium didn't drift. It jumped roughly a third in 3 years, and that's the national blend. Let that sink in. That spike lands hardest where storms, fires, and floods are regular guests, which also hits a lot of households that can least absorb it. It's real. It's happening. Let's break it down. Disaster risk keeps trending up. That pushes claims up, not just in number, but in size, because rebuilding is pricier. Lumber, shingles, copper, labor. Everything costs more than it did pre-2020. Then the reinsurance bill arrives, and it's brutal. When reinsurers raise their prices after bad catastrophe seasons, primary carriers either pass it on or they bail. That's the stack. But here's the catch. Carriers aren't just pricing higher. They're ducking out of entire zip codes. It's musical chairs with fewer chairs every quarter. You pay on time, keep your roof clean, and still end up holding a non-renewal letter like a parking ticket you didn't earn. That's not personal. That's portfolio management under stress. I watched it happen in California. 1 year, a normal renewal. Next year, a non-renewal and quotes in the 5 figures. Not for a mansion. For a regular home that hadn't moved an inch. The cheapest option left was the last resort plan, and it was still a jaw-dropper. You don't forget numbers like that when your escrow is built for $2,000, not 20. This is what the data points to. When catastrophe losses hit and reinsurance resets higher, insurers face a binary choice: price aggressively or exit. Lots of them choose both. The result is fewer carriers writing policies in the exact areas that need them most. Think of it like surge pricing on a rideshare during a storm, except the storm lasts the whole season and the app quietly removes half the drivers. You can wait, you can refresh, you can try a different pickup spot. The price still surges, or the ride never shows. High-risk zip codes are getting clipped fastest. Claims are more severe because rebuilds aren't a weekend project anymore. They're multi-month ordeals with contractor shortages and supply chain lag priced in. Every hail-resistant shingle, every code upgrade, every delay, add it to the claim, then to your premium. And no, the state-backed option isn't a cheat code. It's last resort by design, priced to absorb ugly risk. Coverage can be stripped back. Add-ons cost more. You get a policy, not relief. So the mini payoff. There's no magic cheap carrier hiding in some friend of a friend's spreadsheet. This is structural. Risk, reinsurance, and rebuild costs rewiring the market. Rate shopping helps at the margin, but the tide is higher everywhere. So if you can't outrun premiums, what happens when the rulebook lets insurers drop you faster? That's where the story turns from expensive to existential. So how do you bring insurers back and end up shoving more people into the most expensive safety net in the state? Welcome to Louisiana's fix that breaks you. The new regime sold flexibility and speed like it was a Black Friday deal. Looser rules, faster pricing, more competition. On paper, that sounds great. You get nimble carriers and a market that actually moves. In practice, you get a trap hidden under a welcome mat. Here's the thing. The headline rule lets insurers cancel up to 5% of policies that used to be shielded by the 3-year rule. Every year. It's a pressure release valve for companies that want to trim risk without saying they're exiting. At the same time, the rate game speeds up. Carriers can file increases and, unless the commissioner blocks it within 30 days, those rates go live. That compresses the calendar for homeowners and blasts the accelerator for pricing. Walk through how this hits a normal household. You get a non-renewal letter. You call your agent. They shop. The quotes that come back are thin or non-existent. You end up in Louisiana Citizens because it's the only door still unlocked. The bill? Higher than the private market you just lost, with less flexibility on coverage and add-ons. You didn't choose Citizens. You were routed there. This isn't a one-off. Nearly 125,000 homeowners are in Citizens now, up from a fraction of that a few years ago. Citizens is structured to charge more than private carriers, which is why it's the last resort. Yes, parts of the south of I-10 zone have a temporary suspension of the usual surcharge, but even the state's own leadership admits it barely dents affordability because the baseline is already painful. Let that sink in. The intention was to depopulate Citizens by making Louisiana friendlier to carriers. But here's what nobody tells you. When you give insurers a clean 5% cut option every year, they prune first and ask questions later. The high-risk roofs get trimmed. The book gets lighter. And where do those policies land? Right back in Citizens. That's the funnel. Wider at the top, faster at the bottom. Consumer advocates warned exactly about this. Affordability and access break first. When coverage becomes unattainable, a mortgage stops penciling. Missed escrows lead to ugly outcomes fast. If nobody will pick up a policy after a drop, the house doesn't sell, construction pauses, and households face choices that look a lot like foreclosure risk. Spell out the mechanism so you can see it. The 5% cancellation allowance is a safety valve for insurers, but for you, it's a trap door. Pair that with the 30-day rate review, and you've got rapid-fire pricing plus annual policy shedding. Deregulation aimed to invite competition, but it accelerated non-renewals and drove more people into the last resort pool at higher cost. If the rules can shift under your feet this fast, the old plan of calling more brokers won't save you when the letter hits your mailbox. What if the real move isn't hunting a cheaper policy at all, but getting ready for no policy? Sounds extreme. It's not. The market already told you what it thinks of your roof. So we switch games. We build a moat. Here's the play. A financial moat is defense against uninsurability, not just unaffordability. Think less coupon clipping, more staying power. Rates spike, a carrier bails, a state plan costs more than your car payment. Your moat buys time. Most save money advice stops at raising deductibles and bundling. Useful until a non-renewal nukes your bundle mid-mortgage and your lender starts sending those polite but not polite letters. Step 1 is liquidity. Not vague, emergency fund fluff. Cash specifically earmarked for the house. 6 to 12 months of essential housing costs. Mortgage, taxes, baseline insurance, and a realistic bump for a forced move into the state plan. Why that big? Because premiums don't move in smooth lines. They spike around reinsurance renewals and catastrophe seasons. Timing risk is the killer. You don't want your escrow to implode because your renewal date happened to land after a nasty storm season when rates reprice like concert tickets the minute the band gets hot. Build it fast and boring. Separate account. Automated transfers. Trim discretionary stuff before the house trims you. If your current premium is $300 a month, stress test it at double. If Citizens is your only option, stress test it higher. You're buying months, not a feeling. Step 2 is mitigation that actually prices in. Create defensible space in wildfire zones. Clear fuels, trim trees, ember-resistant vents. In wind zones, upgrade to a fortified roof system that addresses decking, fasteners, underlayment, and sealed edges. These aren't cosmetic. They cut loss severity, which is the lever carriers watch. In some states, local inspections and certifications unlock credits or keep you eligible when the market tightens. California is moving toward catastrophe modeling that ties premiums to mitigation at the regional, community, and individual level. That trajectory matters. It makes your upgrades more than nice-to-haves. They're part of your rating story. Don't overspend on shiny tech that underdelivers. Start with the boring wins inspectors and underwriters recognize. Roof, openings, clearance. Document everything. If a carrier uses mitigation credits, you want receipts ready, not a weekend scavenger hunt at renewal. Step 3 is multi-generational planning. Term life covers the nightmare scenario where income vanishes, but the mortgage doesn't. Aim for coverage that wipes the loan and funds at least a couple years of expenses.